are still stubbornly high. The average rate on the 30-year fixed is 6.95% today. That according to Mortgage News Daily.
The housing market just flipped. So what does that mean for the average home buyer versus an investor like you and I? If you have read Redfin, Zillow, if you've seen anything on social media or the traditional media, what we're seeing is almost 500,000 extra people selling their homes, and the numbers of buyers have plummeted. In fact, that number is 700 billion worth of sitting inventory on the market, out of which 331 billion is stale, meaning has been sitting on the market more than 60 days. So in this video, we're going to break down what does it really mean if you're a homeowner that either wants to buy and or sell property, or what does it mean for you as an investor? Is this a boom or is this a bust? And can the feds change the interest rates again and do a level shift which will flip the market? So let's get started. So let's talk a little bit about history to figure out how we got here. So back in 2008, everybody's aware, 2008 through 2012, we had the Great Real Estate Depression, where we had an unprecedented amount of foreclosures in the entire country, and clearly the markets responded to it by real estate pricing dipped, and it dipped at levels which was unprecedented. But yet, when we look at it, the impact that it had on homeowners was clearly different than the impact it had on investors. And even at that time, as much as it seemed like that entire America was for sale, about 5 to 6% of houses were foreclosed upon. Even though that was terrible, yet on the other hand, if you were an investor, it created a massive opportunity. And if you were a homeowner that stayed in their home prior to 2008, through 2012, eventually the prices have gone way above what they were in 2007 and 2008. So it doesn't necessarily mean it's all doom and gloom. But what about you if you had to sell a house in 2010? What about if you have to sell a house in 2011? And what about today? So how does that impact a homeowner, and where are the opportunities for an investor? So let's look at what has happened over the last 4 years. Well, we go to quarter two of 2020. Quarter two of 2020, the interest rates were at 3.1%. And the average home price in America at the time was $371,000. So to combat the market coming to a standstill because of Corona, what does the Fed do? The Fed lowers the rate. Already they had lowered the rate down to 3.1%, and they further lowered the rate down to 2.96%. Immediately, there was a surge of people who were refinancing their properties because they saw great interest rates. They may have been locked into even 4% or 5% interest rate, and they immediately locked down a much, much lower interest rate. Now, that had the first impact, which is they were kind of locked in not to selling the houses, meaning they had a great interest rates and they did not want to sell the home, because if they sold the home and bought another home somewhere else, now their interest rates would jump, their payments would jump, and that may not be affordable, or that's not something that they wanted to do. Yet that had another impact, which was the second impact, that right after Corona, once everybody realizes we're not all going to be dead, we're probably going to survive, everybody decided to take advantage of the interest rate. Not only just people who were refinancing the properties, but homeowners, first-time homeowners, as well as upgrade buyers, meaning they were moving up into their second property or into a move-up property. And we saw price wars. We saw price wars like never before in history. Depending on the part of the country you were in, people were paying $50, $60, $100, $150,000 over and above the listing price of homes. When the interest rates dropped, a lot of people jumped into the market, and guess what it did? Within a year, we saw unprecedented price range changes in terms of the pricing in the market. The price went all the way from $371,000 to an average of $550,000. Now, where does this data come from? This is not a data that I created, or it did not come from Redfin. It actually comes from the Fed website, which is the St. Louis Feds. So you can always go and pick up more charts, pick up tons and tons of data on housing or the markets in general on that particular website. So what happens? As we move forward and as we come to the second quarter of 2024, or as we look at today, in the first quarter of 2025, remember the pricing had gone up all the way to 550,000. What we see today is now the pricing has come down to 503. So what was the reason for that? Well, by the second quarter of 2022, the Feds realized that they had dropped the rates a little bit too much. And so they tried to compensate for it, because we saw an immense amount of inflation in the economy, and they tried to compensate for it. And by compensating, what did they do? They raised the interest rates all the way from 2.96, 2.7 in some cases if you're doing refis, all the way to 5.34. And then they still felt that that raise in the rates was not enough. So then they went up almost to 6.8. So if you're buying a house, your payment was almost 2.5 times. And so what did the market do? A lot of people realized, oh my God, at these rates, we can't afford housing. In the meantime, not only has the price of homes gone up, but that in tune has coincided with a couple of events, which is, number one is the taxes. The property taxes around the country as a whole, as the property prices go up, the property taxes are benchmarked to the property prices, and so the property taxes went up. Not only that, over the last 2 or 3 years, we saw some catastrophic events around the country that were related to some major storms, some major events, the fires in California, and that has further raised the interest rates, the insurance rates. Because of all of those accumulation of circumstances, what has happened is the number of buyers in relation to the sellers has gone down. So today we see lots of parts of the country, especially if we look at southern Florida, if we look at Texas, if we look at down in Arizona, if we look at parts of Vegas, there are lots of markets around the country, even places like California, that were hotter than hot. A lot of places we're seeing a huge inventory of homes relative to the available buyers that are willing to pay those prices. And so what does that do? There is a overabundance of supply, and the demand is lacking. So let me kind of break this down into actual payments for a person. Let's just suppose you were locked into a property that was $371,000. So what would the payment be if you bought the property in 2020, if you bought the property in 2022, versus if you bought the property in 2025? So if you bought a property for $371,000 and the interest rate in quarter 2 of 2020 was 3.1%, your payment on that property would have been about $1,584. That's your principal and that's your interest. Now, if we go to just a little bit later that same year, the interest rates dropped to 2.96. So your actual payment on that exact same property dropped by another $45. So it was about $1,556. Now, what happened? Just a year and a half later, in second quarter of 2022, the interest rates had jumped to 5.3%, and what we saw was your payment would have gone up to $2,069. That's almost a $500 increase, simultaneously followed by higher insurance rates and simultaneously followed by higher taxes. What happened in 2025? Well, the insurance rates have continued to go up and taxes have continued to go up because the taxes get adjusted in arrears, meaning the property prices go up and the taxes don't immediately go up with it. They go up a year or two behind the property prices. Now, at the same time, the government kept increasing the interest rates, or I should say the Fed kept increasing the interest rates. And today, we're seeing interest rates somewhere in the sixes. So when the interest rates got up to about almost 6.8%, 6.5% for a home buyer, that that coincided with a downward pressure because you don't have as much demand for housing relative to what we saw when the interest rates were really low. That forced down the average price of a home throughout the country. Even a place like Chicago, where the prices have been fairly stable, especially in A and B neighborhoods where there is a undersupply of homes. Even on in those areas, we're not seeing as many multiple offers. We're not seeing as many people buying homes as quickly. At one point, we saw within 4 hours of a home going on the market, we don't see as much demand for properties. In fact, in some areas that are C areas, meaning areas that have a little bit more challenges where the economics are poorer, in those areas we're seeing a building inventory of properties even in markets that are fairly strong like Chicago, Philly, Cleveland, Columbus. A lot of the markets that have been fairly steady, they don't follow the same trajectory as they did in Texas or in areas like Florida where you had overabundance of building. So what does that mean in terms of the number of buyers versus the number of sellers? As we started this particular conversation, if you look at Redfin, if you look at any of the data that is coming out, everybody's predicting across the board that probably we're going to see the home prices sliding between 1 to 2%. In fact, I would go as far as to say that home prices are going to slide between 6 to 15% depending on the location. Now, this is not driven by number of foreclosures. This is purely driven by supply and demand, which is the interest rates. Now, one thing that can change the entire equation, and it can again spur the market, which is the Fed's again responding to a slowing economy, to the tariffs, to a lot of the things that Fed always considers whenever they're making that decision. If the Fed again lowers the interest rates, that may have a reversal effect to this entire trend, which we don't know. But if we look at the numbers today, there are about 500,000 more sellers in the market than the demand. What does that mean? What that simply means is there's going to be a downward pressure in terms of pricing. So if we look at sitting inventory, there's about $700 billion in housing inventory across the board that is sitting, not counting the new construction that is still scheduled to come on board. Out of that 700 billion, there's almost 331 billion of inventory that is called stale inventory. So what does that mean? Well, that simply means properties that are 60 days or more on the market. Generally across the board, historically, it's been considered a healthy market when you have 6 months of total inventory on the market, and we're kind of creeping back to those levels. In some areas like Florida, for every 30, 40, 50 sales, there are almost 500 to 600 properties. So now the inventory levels in those particular markets are 10, 11, 12, 14 to 16 months. But this is not uniform across the United States. So what does this really mean as a homeowner? And what does it really mean as an investor? Well, the way a lot of times the news media portrays it is, oh my God, it's all bad. Or, oh my God, you're left behind. It's all good because you're not participating in the housing market. It's rarely the case. So think about it. If you're a homeowner, clearly no one likes to see the housing prices in their neighborhood go down. Or if you just bought a home, nobody wants to see the house down the street sell for $10,000, $15,000, or a penny less than what your home sold for, because that may reflect that the comps will be lower on your property. But if you're not going to sell the home in the reasonable future, are you okay? You're okay. There is no issue and there is no problem. Yet, the general mood in the market is a little bit of doom and gloom. And if you're going to sell a property in certain areas, that will reflect, depending on when you bought it, in terms of what your price you're going to get. In places like Florida, where people bought the properties at the peak of the market, and if they have to sell today, they're going to be forced to take a haircut, $50, $60, $100,000 haircut, depending on how much you overpaid at the time when we had prices that were unprecedented. Now, in most of the other parts of the country, as long as you have equity in the property and you didn't overpay or you didn't buy it at the peak of the market, you may not get as much, but in general, your pricing is going to be okay and the homeowners are going to fare in a decent condition. What about the investors on the other hand? Well, investors, it's quite different. if you truly are an experienced investor and you truly are buying properties at a wholesale price, meaning you're buying the property at a deep discount and you bought the property at the high time in the market, still, you can unload that particular property as a flip, fix and flip, or you may be renting the property. We have inventory in Florida that we're renting, and we're not able to rent it for the numbers that we thought we were going to be able to rent those properties. Our prediction at the time was that we would get about $2,200 per rental unit. Today, we're only able to barely get about $1,800. That's almost a price difference of about $400 to $500 per property. So instead of being incredibly profitable in a property, today we barely break even in that inventory, or maybe take a $50 loss, depending on who you are as an investor. For someone like me that has hundreds and hundreds of units, that may not be as big a deal, but for someone that only has 2 properties and is barely surviving financially, that may be a devastating consequence, and you're going to get turned away from investing. Yet, if we look back historically, which is we look back at 2008, 2009, 10, and 11, at the same time, while a lot of people, homeowners, were losing properties, or investors who had bought properties just based on the appreciation model, where every year property prices were going to go higher, a market like today provides an incredible opportunity. And here's why. When a market turns down by 5 or 6%, the perception in the market is absolute panic, absolute pandemonium. This is the same exact emotion we see with prices in the stock market, and that's why there's an overcorrection for any type of a bad event. It could be interest rates, it could be what we saw during 9/11, it's what we saw during the pandemic, that the stock market reacts in a very violent manner, and then it will recover over a period of time. Of course, stocks go down at a very rapid pace, and they come up at a very rapid pace. That doesn't happen with housing. Yet, what happens in the housing market? In the housing market, a homeowner may have to sell their home at a 3 or 4% discount. Yet, when we see distress in the market, when we see doom and gloom in the market, a person who has to sell a home ends up selling that property at a 20 or 30% discount. In fact, the discount relative to the market price is 2 or 3 times higher, and that creates an incredible opportunity for you and I as an investor. So if you're an experienced investor that truly understands the market, yes, you may take a little bit of a hit on certain properties if you overpaid. Otherwise, you're going to end up breaking even on those, and you're going to compensate over and above. If you look at how wealth is created in America, in most places, especially as it relates to real estate, wealth is created because you buy properties when the market turns down, and then you hold them through the downturn, and then you really, really profit as the upturn happens. Because not only do you get appreciation, not only do you get depreciation, you get the pay downs as well as rents go up over a course of time. Now, some of you are thinking, but Andrew, in some parts of the country, we have seen a downturn in rents. And that's true. If you bought properties at a high point and you paid retail values for properties, that's the real estate investors generally that tend to get themselves in trouble. So if you're a real estate investor and you are the ones that are smart, you're a pro investor, you're buying properties because you care about value and not just the market. So let me repeat that point. If you're a real estate investor that cares about value, meaning what is the underlying value of the asset and not just dictated by market. And if you're a true investor, what is investing? Investing is buying an asset at a discount so that it will make you money. That's investing. A lot of times investors suffer because they will pay a retail price and they call that investing. Well, for those people that pay a retail price, they're going to see some hard times as we turn down this year into a slow or a market that is going to go down in terms of the actual value of homes. For investors that are pro investors, this is one of the best times, because as the market climate turns to doom and gloom, you're going to get deeper and deeper discounts. And I've always believed that you have to double down in a market as it's getting discounted, because that's when you pick up some of the best properties. You hold them through as long as they're rented out and you're able to service your debt as well, your principal, interest, taxes, and insurance, and you're able to make some money. As the interest rates come down, you're able to refinance it into even better rates and your cash flow goes higher, and now you hold them through as the market comes up. You end up really appreciating on those properties. So this is a complex topic. It depends on who you are, what situation you're in. You're going to respond to it accordingly. Some people will clearly watch the video and say, oh my God, he's just a rich investor and that's all he cares about. And other people will find value in a video like this. But even if you're a homeowner or you're a real estate investor, you have to understand how the market works. If I buy something for retail, be it a car or be it anything else, I'm going to expect that if when I go to sell the property, like if I bought a brand new home and I paid the top retail price, I can't expect it year over year for it to go up. Yet, that's what we have seen. We've seen that all the way across the board. From 2000 to 2008, we saw a ridiculous rise in prices. 2008 to 2012, around the country, the prices corrected. And since 2012, all the way into 2025, we have seen an incredible rise in prices. In some cases, they almost doubled. If not, they were 3 to 4 times, depending on the markets that you were buying in and or you were investing in. As much as I'd like to call this doom and gloom, actually, I like to call it an opportunity, because as a homeowner, you may end up taking a bit of a hit. But on the other hand, as an investor, this is an incredible opportunity. Thank you. Have a good day.